We go to the Vice Chair of the committee, Mr. Rothfus from Pennsylvania, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Heitkamp, I wanted to ask you a couple questions. Last week we had a hearing about the lack of de novo activity that we've been seeing, also a striking consolidation that's been going on in the community banks sector. I'm hearing from community banks on a regular basis and their customers about the post-crisis lending environment and the challenges they face in complying with all of the new regulations. Unfortunately, some on the other side of the aisle dismiss these complaints, telling us that bank lending is strong and that profits are high, so there cannot be any real problems. But I think that's a superficial view of the state of bank lending in our economy today. And what we have is a two-speed economy. There's one speed for the largest firms, individuals with the best credit and the biggest banks, and there's another speed for everybody else. As you noted in your testimony, quote, a customer with a pristine credit score or a larger established business can secure a loan. But those with less than perfect credit, middle and lower income Americans, and those trying to start small businesses are not finding it so easy to access capital. Community bank consolidation and the de novo drought have surely contributed to this bifurcation, since many of these groups would normally turn to community banks for capital. In fact, lending by smaller banks was more than 150% higher than large bank lending before Dodd-Frank, but today it is 80% below large bank lending. Can you describe how regulatory burdens play a role in creating this two-speed economy?
Yes, sir. I think when you look at it and you see the difference with the regulatory burden and talking about de novo charters, I think that's the reason why we have lack of de novo charters is the regulatory burden. You're looking at why you would take that risk and getting involved with the regulatory environment today is you're seeing a lot of people saying there's too many rigs, too many regulations and risks to put my money at work to take that risk.
Can you identify or tell us why certain regulations disproportionately disadvantage smaller banks?
Our compliance costs are through the roof. I can give you, in my bank, for instance, in the last 5-7 years, I have a compliance person, I have a checker of the compliance person, I have people doing the job day to day, and we're looking at that burden every day, making sure that we don't make a mistake, because that mistake will cost us a lot. So the compliance cost is a lot of the burden that we have to deal with.
And how has your bank's lending activity changed as a result of Dodd-Frank?
Our loan-to-deposit ratio is about 70%. We keep it about 80%. It's down about $10 million in the last 5 years. We've been struggling to keep it there. We're trying to hire new people to get it involved, but overall compliance and just the lack of the small to mid-sized customer not having that flexibility where you can come in and sit across the desk and say, I can take that risk with you, with that regulatory risk that we need to take. We're not willing to do that, so it's forcing some of those customers not to have that credit.
Mr. Motley, if I could ask you a couple of questions. In your testimony, you discussed the tremendous uncertainty about how the CFPB will approach various compliance issues. You wrote, quote, despite the extensive liability that can arise from TILA, or the Truth in Lending Act, violations, the CFPB has largely foregone providing guidance on TRID, taking the position that such questions will be settled by the courts. Can you describe how CFPB's regulation by enforcement impacts consumers?
Sure. You know, we can mitigate credit risk. We can mitigate rate risk. We have a very difficult time mitigating regulatory risk because the rules have not been clearly defined in every case. And when we ask for rule clarifications, we get webinars, we get presentations, but at the bottom of every one of those presentations it says you cannot rely on this as being authoritative. You must rely on written guidance, and yet we don't get that written guidance from the CFPB. So it makes it more difficult for us to lend. And when we're faced with the possibility of a loan being kicked out of a pool or a challenge in court at foreclosure time, if there's a problem with the regulatory issues with the disclosures, we're going to run into a problem with that. So we're more likely to take a more conservative approach and lend very much within the credit box rather than out to the edge of the credit box. And if we had more regulatory clarity from CFPB in terms of written guidance, I think that all lenders would be more likely to lend to the edges of that credit box and live within the rules.
Thanks, Chairman. Yield back.
Gentleman's time has expired.